please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to this special edition of Indianomics. Stock markets have given a rousing reception to the government's plan to recapitalize banks with a whopping 2.11 lakh crore rupees. The Finance Minister has asserted that several lead indicators like IIP, core sector, exports are all already showing growth, and the capitalization of PSU banks comes just in time to accelerate the economic growth. Will this capitalization really flare up growth? The other questions also that we will be asking our panel, can so much capital fire up credit growth to a point where we may actually have to worry about inflation? Separately, are we spoiling the PSU banks? Are we giving them capital without fixing governance problems? To answer all these questions, I have with me a star panel, actually. Ashima Goyal, member of the Prime Minister's Economic Advisory Council, but someone venerable here. Bimal Jalan, former Governor, Reserve Bank of India. Samiran Chakraborty, the Chief Economist at Citibank India. And in a bit, we'll also be joined by Dr. Rakesh Mohan, former Deputy Governor of the Reserve Bank of India. First up, let me get Dr. Jalan on the growth issue. Dr. Jalan, do you think, sir, that because of this capitalization, we are going to get a substantial jump in growth? Was PSU lack of capital the big roadblock, and with that removed, we're going to get good growth?
No, naturally, but the sentiment has become very positive, as you can see. Earlier, if you go back, say, 1 week ago, the sentiment was not this positive. I mean, there were two views. Whether it will work, it won't work, how are we going, whether it will be a cyclical move or a structural problem that we are seeing in our economy with the growth rate being low and inflation being low, despite the fact that we had high foreign exchange reserves and so on and so forth. And the corporate sector was waiting, the public sector had high losses, high NPAs and so on. So all this is a past now, so far as we are concerned. And so this is a very positive move, and recapitalization of this magnitude hasn't been done before. There was a recapitalization in 1990s, for example. But this is a very, very positive move in my view under the circumstances, because all our factors of production are positive. Inflation is low, foreign exchange reserves are high, our trade sentiment is very good, we can export, export demand is high. So everything, and technology, of course, we are among the best in the technological power that we have. So all the factors of production are very positive for us and today. And so the move that has been made in terms of recapitalization, it has a very positive impact on what you might say the prospects of the economy, to my mind.
Okay, that's good to hear from you, sir. You're a veteran of many cycles. But let me toss that to Ashima. Ashima, would you agree? I mean, if you looked at the disruption in the GST and some hangover of the demon problems as well, are we really in a position to take advantage of this surplus credit right away? Or do you think we will have to wait a couple of quarters?
No, I think we will have to wait. It is true that the sentiments are very positive, but market sentiments were always, the stock markets were always doing well. But we've had, private investment has been low, domestic demand has been low, credit growth has been low. And if you talk to bankers, then the constraint is not really the supply of funds. They are holding excess SLR just now. The constraint is really a lack of demand for funds. And you won't see that turning around that quickly. But that said, there are a number of factors that suggest that demand will also pick up, because consumption had received a temporary negative shock from demonetization and GST, which maybe is behind us now. And the world export growth, growth is looking up. That should be favorable for export growth.
Samiran, before we come to that part, is growth evident for you in the second and the third quarter itself, or third quarter for that matter, because now banks should be able to lend right away?
I don't see an acceleration in this quarter just because of the plan being announced. Having said that, I think the way I am looking at it is that is there a problem of demand for credit versus a problem of supply of credit? And we never knew the answer. Now we'll come to know the answer, because at least one part of the puzzle, which is the supply of credit, at least that part is going to be taken care of through this recapitalization plan. And since the private sector banks' credit growth was much higher than the public sector banks before this announcement, one can presume that there was some latent demand which these private sector banks were servicing. So now if the public sector banks, because of better capital, comes in there, then it could affect credit growth.
Do you think, Samiran, the government could say that we are giving you all this capital and we want you to concentrate on MSMEs or SMEs? If they did that, could this be counterproductive? I mean, more bad loans? Because I don't think the PSUs as yet have the data or the analytics capability.
So at this moment, it's tough to say whether this will be some kind of a tied scheme or not. But it's also true that MSMEs are a big driver of the economy, and if you look at the credit growth to this segment, that has been quite weak in the recent past.
Do PSUs have the wherewithal?
Idea to try to stem that.
No, but would PSUs have the wherewithal to sift and give credit to the right guy on the right parameters? I know some of the NBFCs have developed some bit of a database on it, but public sector banks for the last several years have become wholesale even in their liabilities, and they had to be weaned away from it. So do you think if they are directed, would that be a good idea?
We have to kind of keep in mind that recapitalization is not a solution to all the problems of public sector banks.
Okay.
It does not necessarily increase the efficiency of the public sector banks in any way. So, but at the same time, it's also true that if you take out the last few years, for a pretty long period, we were funding MSMEs through public sector banks only.
Okay.
So that model can come back into play if it is done properly.
Okay. Just your growth numbers, Samiran, before I go to Ashima. What are you expecting this year in terms of GVA?
So we were looking at around a 7% GVA number for the full year, which I know is a little bit on the higher side, because we think that last year's Q3, Q4 numbers would probably be revised down, and that would give a nice base effect for this year's Q3, Q4 to be seen as much higher. Okay.
Ashima, I wanted to ask you another question. Actually, on this, if this recap were to come the way it is, 2.11 lakh crore, it is quite possible that at least 1 lakh crore is going to be growth capital. Now, in the hands of banks, it actually gets a multiple of 10. So, we are staring at a fairly sharp rise in credit if indeed it is put to use. I mean, are we doing too much too soon? Should the RBI have to keep a hawk eye on inflation next year?
No, well, I think that the government's push, for example, is on the supply side, infrastructure, etc. So, there are other reforms on agriculture which are keeping food prices, good monsoon, etc., moderate. The rise in prices has also been moderate, the procurement prices. So, as long as all these factors play out, I think we are seeing that prices have been low for a long time now. But somehow we don't want to believe this. So the RBI, for example, is convinced that it will rise. I'm not so clear that it will. I think many of our price indices have been revised downwards, for example. So there are a lot of things happening there we're not even measuring properly.
Okay.
So it should be kind of data-driven. RBI's past few inflation forecasts have all been biased upwards. So I don't think we should be so quick to assume that inflation will rise, and we should wait to see if it does. And as long as food inflation is contained, I think we will be okay. But one point I had about these public sector banks and this huge amount of credit which they can potentially lend, they have been really bitten by this last episode.
Yes.
You know, once bitten, twice shy. And they are just trying to clone private sector banks now. They are searching for retail lending. They don't want to lend to firms. But our problem is that credit to firms is absolutely, you know,
essential.
very low rates of growth. And you cannot grow without that. So, and at the same time, various reforms have been undertaken, improvements in governance, and I don't think anybody is going to tell them to lend without proper evaluation.
Okay. What's the GVA number you will work with?
I think 6.5, rising to 7 by the end of the year.
Okay.
But at present, it's not going to be that high. But, you know, another positive factor I see is that a lot of, you know, the RBI has been worried about transmission of interest rates. Now, they were not cutting loan rates because of the risk built in from NPAs.
Yes.
Already, there's been talk of reducing loan rates, which will be a positive for
Yes,
demand
certainly.
for credit.
Certainly, yeah. There would be greater competition now that the banks will be emboldened to lend, and that might push up growth. Well, we have to take a very quick break and come to the other part of the question, governance reforms in public sector banks. Has the money come too easily? That question after this break. Welcome back to this Indianomics special. We have been discussing whether the bank recapitalization will fuel growth, but the other big question is whether the bank capitalization has happened without too much of governance reform. We have been speaking with Dr. Bimal Jalan and Ashima Goel. We are joined by Dr. Rakesh Mohan as well, former Deputy Governor of the Reserve Bank of India. Well, Dr. Mohan, welcome. But first, a question to Dr. Jalan on this. Dr. Jalan, do you think PSU banks should be given the capital only after some serious governance changes? For instance, you know, their boards tend to get dominated by, you know, sometimes even party nominees because they come under the Banking Companies Act. Should we first move banks to, say, the Companies Act so that there are at least more safeguards to the board?
You have raised a very important issue. I mean, I have also written about it in the past, but let me tell you that this is the most important issue that you have raised in terms of what you might say governance aspects. That the government should decide policy. What is our policy? How much money we can spend from the budgetary side? How much money we can spend through the bonds and so on and so forth? That's for the government to decide. It also decides whether what is the priority of investment, you know, in terms of say roads or railways or ports or whatever, you know, and so it has to decide that. But then the governance part, I mean, on the ground should remain with the governing board of the banks, and the governing board of the banks should be judged on the basis of performance and not because they are government banks. You see what I mean? That, I mean, there is no reason why you can have you can have the board that you want, you know, and you can put one or two of the government representatives on that, just as promoters can be on the private sector banks if they want to be on the board of the private sector bank. But if the government keeps what you might say an arm's length distance from implementation part, that would be a very positive move. So I agree with your point.
That arm's length is exactly what we have not seen happen in the past several decades, you know, through several governments, several party governments. Dr. Mohan, what's your sense? Yes, banks have been capitalized, that's very good. But have we really fixed governance? Should we have a UPSC kind of board which will select the board members? Should we do something, you know, or move it to Companies Act, the entire banking companies?
Well, I don't think that movement to a Companies Act would make much difference.
Okay.
So after all, even if it's under the Companies Act, as long as they're public sector banks, it will be the government nominating the board members.
Yeah, but the voting percentage at least will be according to reflecting the shareholder. Now even that is not there.
Well, given that the government, as long as they remain public sector banks, given that the government will always have a majority share.
Yes.
So I don't think that those things make much difference.
Okay.
of course, it should be the case that we should not be politicizing the nominees as board members.
But how do you depoliticize them, sir?
Well, I think we have to face the fact that as long as we do have public sector banks, with some rationale for having public sector banks, then these issues will remain. But I would go a little further in the sense that it's really the management of the banks that is much more important as opposed to the board composition.
Okay.
You really have to ask the question, even in private sector banks, how much do boards have really to do with the actual decisions in the bank apart from policy decisions?
Okay.
And so my own view has been that the problem that took place, perhaps between 2009 and 2014, or something of that order, maybe 2015 perhaps, was the government behest to public sector banks for lending, particularly for PPP projects, where we went excessively into PPP.
Yes.
So the question goes back really to the government as opposed to the banks. The public sector banks are there because you want public sector banks so that they carry out government policy on certain issues. Otherwise, you don't need public sector banks.
Okay. Yeah, then that's my next question. And let me get Dr. Jalan and Ashima on that. Dr. Jalan, do you think government should privatize some of the banks?
No, yes. I mean, if again, let me repeat what I said. Where there is a public interest involved, you should have a public sector bank. Like, say, cooperative banks. You know, if a public interest is involved, you have a public sector bank. Building roads, infrastructure, you need a public sector bank. You know, because they don't have to depend on the rate of return to provide public services.
Are you
but
saying...
you have to choose in saying what is a private interest and what is a public interest. If somebody is doing something which is only a private interest, then you can privatize it. There is no problem, provided there is enough capacity in the private sector to implement that private sector thing that you have, like buses.
Dr. Jalan, you know, are you saying then it is okay for public sector banks not to post profit at all? I mean, they're listed.
But remember, Latha, that you know, they want to make profit, but you may also keep in mind that the shareholders, the prices of public sector shares would depend on what you are referring to as the profitability and so on. And if the government is the main holder, then that doesn't matter. You see what I mean?
Well, okay, well, let me get Ashima Goyal in this. Ashima, my only fear is that a large amount of capital is going to be given, but we have not taken any tough decision on public sector bank governance. I mean, a UPSC kind of body selecting their boards, or even bringing the stake below 51%, so that they can laterally recruit and not be under the lens of the CAG and the CVC, you know, given ESOPs so that the managements are more proactive. Don't we have to take all these hard decisions?
Yeah, I think there has been a move to bring in more market discipline. The idea of reducing government share to 50% was to bring in some other shareholders and therefore market discipline. So that can go along further. The share could come down more and release them from CAG audits, etc. But I think there can be a move towards increasing the skill levels in the management, towards improving the quality of people you get, getting more independent directors and skilled people on the boards. All that, you know, the Nayak suggests committee reforms, holding company, all these kind of, but I don't, can be undertaken and should be, but I don't agree with you when you say that there are no reforms, because I think the reason we've had this huge delay in recap, in a way, dealing with this problem was, it all got aggravated because we started with recognition, you know, the regulators forcing them to recognize without infusing capital. Yeah, without doing sufficient reforms, those should have come.
I completely take your point on that. The regulator has been doing an A-class job, you will have to say. They first forced both borrowers and the bankers to recognize the stress, and borrowers clearly have been put on notice. I'm not taking that away, but you know, we're out of time. Dr. Mohan, we have to wind up this conversation. Dr. Mohan, your last thoughts. We are giving a large amount of money, and much of it, the interest at least, is coming from taxpayers. How do you think we can ensure that public sector banks will not get to 20% NPAs yet again?
Well, you have to, people seem to forget completely that the same public sector banks performed extremely well in the first 10 years of this century, that is from around 2000 to 2010 or thereabouts, with the same kind of management structures, same kind of governance structures, etc.
Okay.
I think that that's a kind of question that has to be asked. What was happening then? What happened after that? And my understanding is that perhaps there was more government interference, more government behest after that period.
Okay.
And that is what has to be stopped.
So how do you stop that?
Well, I guess the government has to itself restrain itself.
Okay.
I think that too much blame
institutional mechanisms to discipline the government, sir? Some institutional mechanisms to discipline the government, to ring-fence managements?
You know, once again, as long as the government has a majority share, that was done for a long period of time in the late 90s and the 2000s.
Okay.
The government had stopped interfering to a great deal. And you saw the results in the...
You don't back privatization. You don't back privatizing some of the banks.
No, that's not the issue. See, privatization, to my mind, is not a solution. Because after all, the biggest private sector banks in the United States and Europe, with
Also
all the
problems.
very, very fancy management staff, etc.,
All right.
got into a financial crisis with the largest amount ever,
All right.
much more than the Indian public sector banks
Point
in
taken.
2007-8.
I think you are on the same
So,
page
you know,
as Dr. Jalal. I take your point, sir, that yes, you need governance to be resolved. I'm really sorry we're out of time. Dr. Jalal, Dr. Mohan and Dr. Ashiva Goyal, thank you very much for joining us in this conversation. So yes, sir, we may have to retain the public character of public sector banks, but we have to improve governance issues. That's the statement coming in from our experts. Thank you very much for joining us on this special edition of Indianomics.